Welcome to the Global Commerce Academy, your destination for 100% free CMA USA classes. In this lecture, we continue our journey through Section A, External Financial Reporting Decisions, and today's topic is Chapter 2, Recognition, Measurement, and Valuation. This chapter forms the technical core of accounting. It answers the question, when should a transaction be recorded, at what value, and how? Section 1. What is recognition? Recognition means recording an item in the financial statements. For example, a sale is recognized when it is earned, not when cash is received. An expense is recognized when incurred, not when paid. The two main recognition principles under accrual accounting are the revenue recognition principle and the matching principle. You'll often see journal entries and timing questions based on this concept in the CMA exam. Section 2. Measurement. How much to record? In accounting, after you've determined what transactions or events should be recognized in the financial statements, the next crucial step is to figure out the amount at which these items should be recorded. This process is known as measurement, and it's a fundamental concept that underpins the reliability and comparability of financial information. Measurement answers the question, at what value should we record this asset, liability, income, or expense? The answer isn't always straightforward, and it depends on the nature of the item and the accounting standards being followed. Once you've identified what needs to be recognized, you must decide how much to record it for. This is where measurement bases come into play. The choice of measurement base can significantly impact the numbers reported in the financial statements, and ultimately, the decisions made by users of those statements. Let's explore the most common measurement bases used in accounting. The first and most widely used measurement base is historical cost. This means recording an asset or liability at its original purchase price or the amount of cash paid or received at the time of the transaction. Historical cost is popular because it's objective, verifiable, and easy to understand. For example, if a company buys a machine for $10,000, it records the machine at $10,000, regardless of how its value changes over time. Another important measurement base is fair value. Fair value represents the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. In other words, it's the current market price. Fair value is especially relevant for financial instruments like stocks, bonds, and derivatives, where market prices are readily available and fluctuate frequently. Net realizable value is another measurement base, and it refers to the amount of cash or cash equivalents that an entity expects to collect from an asset after deducting any costs necessary to make the sale or collection. This is commonly used for accounts receivable and inventory. For example, if a company expects to collect $9,000 from its customers after accounting for potential bad debts, that's the net realizable value. Present value is a measurement base that involves discounting future cash flows to their value today, using an appropriate discount rate. This method is often used for long-term receivables, payables, or pension obligations, where the timing of cash flows is critical. By discounting future amounts, present value provides a more accurate picture of what those future cash flows are worth in today's terms. Replacement cost is another approach, which measures the amount it would cost to replace an asset with a similar one at current prices. This is useful for assets that are subject to frequent technological changes or price fluctuations, such as inventory or equipment. Replacement cost helps ensure that the value recorded reflects the current economic reality, rather than outdated prices. To put these concepts into context, let's look at inventory. Inventory is typically recorded at the lower of cost or net realizable value. This means if the market value of inventory drops below what the company paid for it, the inventory is written down to its net realizable value. This approach ensures that assets are not overstated on the balance sheet and reflects potential losses in value. For financial instruments and investments, fair value is often the preferred measurement base. This allows companies to reflect the most up-to-date market information in their financial statements, providing users with relevant and timely data for decision-making. Ultimately, the choice of measurement base depends on the nature of the item, the purpose of the financial statements, and the requirements of accounting standards. Understanding these measurement bases is essential for interpreting financial statements and making informed business decisions. Evaluation is a fundamental concept in accounting and finance, ensuring that the amounts reported on financial statements truly reflect the underlying economic reality of a business. It's not just about plugging in numbers. It's about making sure those numbers represent what's actually happening in the business world. Accurate valuation helps stakeholders, like investors, creditors, and management, make informed decisions based on reliable data. Without proper valuation, financial statements could be misleading, resulting in poor business decisions or even regulatory issues. For example, when a company records accounts receivable, it must consider that not all customers will pay what they owe. To address this, accountants estimate a bad debt allowance, which reduces the reported value of accounts receivable to a more realistic amount. This adjustment ensures that the balance sheet doesn't overstate the company's assets and gives a clearer picture of what the business can actually collect. Similarly, long-term assets like equipment, vehicles, and buildings lose value over time due to wear and tear or obsolescence. Depreciation is applied to these assets, spreading their cost over their useful lives. This process not only matches expenses with the revenue they help generate, but also prevents the overstatement of asset values on the balance sheet. Inventory is another area where valuation is crucial. Sometimes the market value of inventory drops below its original cost due to damage, obsolescence, or market changes. In such cases, inventory must be written down to its net realizable value, the amount the company expects to receive from selling it. This adjustment ensures that assets are not overstated and that losses are recognized promptly. Here's a CMA tip. Understanding how valuation adjustments impact both the balance sheet and the income statement is essential. When assets are written down or depreciated, it affects not only the reported asset values but also the company's profits, since these adjustments are recorded as expenses. If assets are undervalued, it can lead to understated equity, making the company appear less financially healthy than it really is. On the other hand, overstating expenses, such as excessive depreciation or bad debt allowances, can result in understated profits, which might affect management decisions, investor confidence, and even bonus calculations. That's why mastering valuation principles is key for anyone involved in financial reporting or analysis. Let's take a real-world example. Suppose you sell goods worth $10,000 to a customer on credit. Under accrual accounting, you recognize revenue of 10,000 rupees, even if it's not yet received. You also create accounts receivable on the balance sheet. If there's a chance of non-payment, a provision for doubtful debt is made. This really just shows how recognition, measurement, and valuation all work together. You can expect CMA questions on matching revenue with related expenses measurement basis for different asset types, valuation adjustments like impairment or allowance for bad debts, and the differences between accrual and cash basis accounting. Also, journal entries for recognition and measurement are often tested. Here's a tip. Make sure you understand how each action affects both the profit and loss statement and the balance sheet. And that brings us to the end of Chapter 2, Recognition, Measurement, and Valuation. We've covered a lot of ground in this chapter, from understanding how businesses recognize transactions to the ways in which assets and liabilities are measured, and finally, how everything is valued on the financial statements. These concepts are absolutely foundational for anyone preparing for the CMA USA exam, and mastering them will give you a strong base for all the advanced topics to come. Take a moment to review your notes, and don't hesitate to revisit this chapter if you need a refresher. In the next chapter, we'll be taking a deep dive into revenue recognition, one of the most critical and frequently tested areas in accounting. We'll break down ASC 606, the standard that governs how and when revenue is recognized, and walk through each step of the process with real-world examples and practical tips. Whether you're new to accounting or brushing up for the exam, you'll gain a clear understanding of how companies track revenue, what the 5-step model looks like in action, and why it matters for financial reporting and decision-making. If you found this chapter helpful, make sure to subscribe to the Global Commerce Academy. We're committed to providing you with every chapter of the CMA USA 2025 syllabus, explained in simple language and absolutely free. By subscribing, you'll get instant access to new lessons, exam strategies, and exclusive resources designed to help you succeed. Don't miss out on any updates. Hit that bell icon so you're always the first to know when a new video drops. We love hearing from you. If you need free notes, practice questions, or have any doubts about the topics we've covered, just drop a comment below. Our team is dedicated to supporting you every step of the way, and we'll make sure you get the resources you need to pass the CMA USA exam on your very first attempt. Your feedback helps us create better content, so let us know what you want to see next. Thanks for watching, and see you in the next chapter.